Welcome to the Thomson Reuters Idea of the Week and Alpha Now. I'm John Cozy. The worry about the U.S. fiscal cliff includes higher tax rates on dividends and their impact on higher dividend-yielding stocks. So what do you do if the same dividend payment leaves you with less money after tax? In a 2006 research report, Credit Suisse analyzed different types of equity strategies that beat or fell short of the S&P 500 average, including owning companies with both lower dividend yields and low dividend payout rates. That approach has beaten the market over time, and it could be more attractive in taxable accounts than higher yielding stocks. We took that strategy and added a StarMine screen that helps avoid potential speed bumps in return. So let's take a closer look. We searched for U.S. companies in the bottom 20% of dividend yields. That's around 1.4% or less, compared to the S&P 500 dividend yield of around 2%. We also screened for companies that retained 80% or more of their earnings, had over $500 million in market cap, and which trade at least 200,000 shares a day on average. Finally, we screened for earnings sustainability through the StarMine Earnings Quality Model, or EQ. That way, if the U.S. economy hiccups in 2013, these firms may be less susceptible to earnings plunges than those with lower ranks. The resulting low dividend yield and low payout ratio screen results in 151 companies. At a high level, the market cap weighted stocks show 23% higher earnings growth projections over the next 5 years than the S&P 500, at 9% versus a 7.3% estimate. The list also shows a more attractive price to free cash flow ratio of 11.8 times for the list versus the S&P 500's 13.6 times. The 2013 list favors more of an expanding economy compared to the S&P 500 index. You can see that in this StarMine attribution chart. The bar graph shows green overweights around 9% in consumer discretionary and 6% for financials. Those sectors benefit more than average from an expanding economy. The bottom portion reflects the underweight sectors in red, including the more defensive consumer staples at 8% underweight and healthcare at 4% underweight. The biggest number of names is in the industrial sector, including Chicago Bridge and Iron. The firm has a 0.5% dividend yield, but a perfect 100 out of 100 score in earnings quality. Even the underweight consumer staple sector contains 5 names, including Weight Watchers International. For a complete list of our 2013 low yield and low payout companies, click on the link attached to the text article of the story. For the Thomson Reuters Idea of the Week and Alpha Now, I'm John Cozy.